I can see it's here that there's things that you didn't include. I just gave them to you right now. So go crunch your numbers. But those factors of looking for about 40 pips maximum is based on several things. And this is where you should be writing things down, folks, because if you're just driving down the road, chewing on your bubble gum and corn chips and shit, that ain't going to be good. You're going to have to come back and listen to this and write down some notes. Generally, from the open at midnight to the high of the day, it's usually within 30 pips that it makes the high of the day. Sometimes, in some weird instances, it'll go as much as 40 pips. Why 40? Because sometimes you'll cross and breach a big figure number, for instance, a 0 level. Okay. And if that's the case, the algorithm can many times spool or spread beyond a particular level, run past it, in other words, as much as 40 points or 40 pips. So that's why I use 40 pips as a general rule. And if it goes beyond 40 pips, then it's probably not going to be a sell-off. It's probably going to keep going higher. Or it means I need to sit on my hands and do shit. Nothing. Just go back to bed. And then I'll trade the New York session. Okay, so I just tossed it in there, no extra charge. But using our example for pound dollar in the New York session, if we are expecting something bullish, our weekly analysis indicates that we're in a buy model. There's a high impact or medium impact news driver coming out at 8:30 or so in the New York session, all New York local time. Everything is always New York local time. Stop trying to take your shit in your chart and line up to your local time because it makes sense to you. Everything in these markets are always going to be on Eastern time. I don't give a fuck who tells you different. I don't care how long they said they've been trading. I don't give a fuck. Okay, that's all bullshit. Everything, all these algorithms is doing is running on New York time. Midnight in New York, that's the beginning of your fucking day. It's not Wellington. It's not Asia. Okay? It's New York midnight. That's the opening. Okay? I don't give a fuck. Anybody tells you different, that's the way it is. And you bring them, if you're here listening, you bring your shit and I will run right with you and I will run fucking circles around you and show you exactly what these fucking markets do. But you're gonna fucking be schooled. So don't talk your shit in your little private little circles, okay, your little fucking webinars. Talking all your bullshit because you ain't getting the balls to come here directly. You do it right here and I will run circles around your motherfucking Mickey Mouse ass. Clown. UK boy. So once you have that, you're waiting for price to either drop down, no more than 40 pips, down to a low. But if it runs down below a low that's lower than 40 pips, you don't do anything. You leave it alone. You wait. Just let that go. But if there's a low that say it's at 40 pips, lower than the market price, before that news driver comes out at 8:30, you look inside that low to where the market price is now. There should be a price leg that has moved up. Is there a fair value gap in that? If there is, then you're anticipating now that the market drops down into that fair value gap and not below the low. Now, here is that point of contention that every student of mine has, even private mentorship students. They want the silver bullet answer that says, okay, here we are. We're at the brass tacks. This is where the rubber meets the road. ICT, lay it on me, baby. This is it. Hear that? That's excitement in your voice. You're talking to yourself, and I'm not in the room with you. How do I know, ICT, that I can buy that fair value gap and it won't go below the low? Are you ready for this one? Ready? You got your pen and your paper? Write down this. I don't fucking know. You don't know. That's why you put a stop loss there. Are you fucking kidding me? Yeah, that's it. But what happens if it goes down there and I get stopped out? What you do is you wait for it to create a short-term high. And then if it goes back below that short-term high, that's a shift in market structure. Wait for another fair value gap. Then you buy that one with half the risk that you lost on the first trade. If you lose on that one, you're done for the day. Done. How's that fucking complicated? It's liberating. You don't have to know. But if it does happen to you adversely, you know what you're going to do. And if it happens again as an adverse effect and you lose, you're done. You're fucking turning the charts off. You're done. That's your morning routine. You're done. You did your 2 trades. You've lost on both of them. You're done. Or the second one wins and you recuperate some of the drawdown, if not all of it, and maybe go into profit. That's the part that's going to separate all of you from the people that stick with this. Because if you can't accept the fact that you're probably going to lose and it won't change anything, it just takes a little bit away from you. Just like it takes away from your fucking gas tank when you drive to your fucking slave job. Okay? It costs you money to go to work, but you don't ever look at it like that. It costs you toll money to get to work, but you don't look at it like that. That's a fucking loss, okay? Your stop loss is getting hit every fucking day. As soon as you start that car up and you're driving down the fucking road, your stops are getting hit. It's costing you fucking money. You got to replace a fucking tire. You got to replace your tires. You got to change your fucking oil. Guess what? That's drawdown, baby. It's all about perception. You're running around with blinders on. You can't do this and not lose money. You're going to lose money, but you have to manage effectively how you lose it and come back from it. So you're going to do one of those two things. You're going to look for a swing low. Now, if it's less than preferably 30 pips, that swing low on the hypothetical example of pound dollar, I would, even if it had a fair value gap, I would give it the likelihood or the opportunity to trade below that low, especially if it's a high impact news driver. I would look for it to potentially run that low. But if we trade down to the fair value gap in that low, if it's less than 30 pips, I sacrifice that entry that would have been at the fair value gap because I'm waiting to see if it wants to take the low out. If it takes no interest in going below that low and it reacts at the fair value gap, then what I'll do is I'll buy the next down close candle as an order block. That's it. Isn't that straight to the fucking point, folks? Okay? You young guys, get to the fucking point. You can't get any more to the fucking point than I'm doing right now. I'm literally giving you IPDA step by fucking step, and you're still gonna fucking complain. Whatever. So what you're doing is you're determining if you're bullish in a buy model, you're expanding higher on the weekly candle, you're waiting for opposing price direction at the time of the news driver being released. Okay, so whatever, like an employment number or an economic number that comes out, you're expecting the algorithm to reprice lower, and that's going to get all the retail traders wanting to go short. That's exactly what you want. That is the green light go you're looking for. You want to see something opposed to what you think the weekly candle is going to do at that time of that report. That's manipulation. That's the trick. That's the broken wing trick that the robin does to protect its little fledgling that's trying to teach how to fly. You ever seen that, a robin on the ground? And you see it, it sees you before you see it, and it starts chirping real loud, and it starts putting its wing out to the side like it's broke, and because it wants you to chase it. And once you get close to it, that fucking wing's perfect. It flies away and it's laughing at you. But you don't see the baby it's distracted you from. Well, the market does that same kind of thing. That's a Judas swing. It leads you down the primrose lane. It makes you think you're seeing something that's valid, but it's not. And it catches people that are offside because they're ignorant. They have no idea what the fuck they're doing, and they're chasing excitement. Just like a predator. They want to chase the thing that's running. Well, when the market runs, you think about what that's done. You have all these people that are neophytes. They're traders that have no idea what they're doing, and they're just anticipating doing something next, but they don't know what it is to do because they're looking at these candles forming and they have no idea. But when there's an excitement and it moves really, really fast low, real quick, sudden, what does that mean? Oh man, I'm missing it. FOMO kicks in, fear of missing out on the move. It's already dropped 20 points. Man, it could go 100 points today or 100 ticks today. And I don't care if I missed the first 30. Let me just get in there right now at down 32 ticks. So you shorten, or they're shorting rather, into that move when you're looking to go long. That's smart money. That's what institutional mindset is. Okay, you're looking for the opposing view of what you're trying to do. That's that market efficiency paradigm. Remember month 1 in the core content? That's what you're doing. Smart money is a small little circle of entity that uses the greater community against themselves. But they have to have that smaller community to act as a counterparty. So they use enticement, they induce the excitement of seeing these big movements, and it trips them up. and they're rushing into the marketplace with liquidity.